When investors evaluate a stock, portfolio, or investment strategy, one of the most important questions they should ask: how much market risk am I actually taking? As portfolios may generate strong returns, but those returns are coming from skill and strategy, or are they simply coming from the market moving higher? This is where beta becomes important measurement. Beta helps investors understand how sensitive an investment is compared to the overall market. In this video, we're going to explain what beta measures, how beta is calculated, and why beta matters when evaluating market neutral and alternative investment strategies. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. Beta is a measurement of systematic risk, or the risk of an investment relative to the broader market. The market is usually represented by an index such as the S&P 500 or the NASDAQ 100. The S&P 500 is often assigned a beta of 1. And a beta tells us on how the investment typically moves compared to that benchmark. For example, a stock with a beta of 1 would be expected to move approximately in the same direction as the market. If the S&P 500 rises 10% and the stock is beta 1, then theoretically it would rise by 10%. And if the market drops by 10%, well, the stock would drop as well. But investments do not always move exactly the way the market goes, and that's why beta is useful. So let's look at some values. A beta above 1 means that the investment tends to move more aggressively towards the market. Example, if a stock has a beta of 1.5, that simply means that if the market rises 10%, the stock may rise approximately 15%. If the market falls 10%, then the stock can drop by 15%. Higher beta investments can provide greater upside potential, but they also carry greater downside risk. This is one of many strategies DataBridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. A beta below 1 means the investment historically moves less than the market. Those investments may provide more stability but often have lower growth potential. A negative beta means an investment tends to move in the opposite direction. Examples will include certain hedging strategies like puts and calls. If the market declines a negative beta, an investment may increase in value. These types of assets can be useful in portfolio diversification and risk management. Beta is calculated by comparing the relationship between the investment returns and the market returns. In simple terms, beta measures how much does that investment move when the market moves. Beta and alpha are often discussed together, but the measures are different things. Beta measures the market exposure, while alpha measures the performance beyond the market exposure. For example, suppose the S&P 500 returns 10%. A portfolio with a beta of 1 would be expected to return approximately 10%. But if the portfolio actually returns 15%, the additional 5% may represent positive alpha. The goal is for many active managers not to simply achieve market returns. The goal is to generate returns that are not completely dependent on the market direction. For investors evaluating alternative investments, beta becomes especially important. Traditional long-only funds may have a beta of 1. That means when the market rises, the portfolio participates in the upside. When the markets fall, then the portfolio declines accordingly. A market neutral fund attempts to reduce the market exposure. For example, a strategy with a beta close to 0 attempts to generate returns independent of whether the market goes up or down. That focus shifts from did the market go up to did the investment strategy produce the returns regardless of the market direction. And this is again what DataBridge management uses all the time. This is why beta is an important metric when analyzing hedge funds, alternative investment strategies, and risk managed portfolios. Beta is one of the most important tools because used for understanding risk. Investors should also evaluate alpha, maximum drawdown, volatility, Sharpe ratio, and risk-adjusted returns. To learn more about DataBridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.